the inheritance tax that you're not aware of. So I just got done listening to a podcast, and the guy was asked about inheritance and estate taxes. He did a good job, but he missed the point that I think a lot of people need to understand. All right, so just FYI, essentially, there's no estate tax from the feds today. There's just not. I mean, yes, if you have, 6, 7, 8 figures, there could be an estate tax, which includes life insurance. But from the federal government, it's just not an issue for, the people I'm running with. If you live in Massachusetts, Illinois, Oregon, a couple of these states, Minnesota, I believe, there's a pretty low exemption for an estate tax, and so your estate could be subject to estate tax in one of these blue states for sure. But be that as it may, and again, that includes life insurance. Everyone thinks, no, it doesn't. It transfers tax free. No. It transfers subject to an estate tax. That's not debatable. So I can't tell you how many seminars I've done. I've done estate planning. I told people, look, if you own life insurance, it is part of your estate at your death. Even if you're not the beneficiary, which you wouldn't be, because that wouldn't make any sense. But you own it, it's in your estate. I don't care what it is. If you own it, it's in your estate. All right. So estate tax on issue. Inheritance tax, Pennsylvania, Kentucky, Maryland has an inheritance tax. New Jersey has an inheritance tax. A little bit different. Inheritance taxes are kind of, despicable in my opinion. But be it as it may, you'd have to be wary of inheritance tax. I'm not going to get that here right quick. But the inheritance tax that most of us will pay is when you inherit an IRA or a 401k or a TSP or a 403b or a deferred annuity. There's something called income with respect to decedent, IRD, that a lot of people are not aware of, and it's too bad. And maybe under the Secure Act, people get more and more aware of it because it's going to come forceful here when you inherit an IRA, 401k, something like that. So here's what happens. Mom dies, she left you $250,000 in an IRA. All right, you inherit that IRA. All right, you can actually, you don't have to pay tax right out the gate because you can just roll it into an inherited IRA. But you still have required minimum distributions, RMDs, all right? And you have to pay income tax on those RMDs. So let's just say you have mom, she's a retiree, and she squirreled away money, has $250,000 in IRA, and she's living off her Social Security, that's it, plus her required distributions, not much. So she's probably in the lowest tax bracket if paying any taxes at all. You, on the other hand, are a radiologist. So now you inherit that $250,000 IRA from mom. You have to start pulling money out of there, and you have to start paying income tax on it based on your income as a radiologist, which is going to be a heck of a lot higher than what your mom was, because your mom basically had no taxes. Big mistake. Don't do that. So what happens here is we're saying, okay, son, here's your $250. Good luck with that. And son's like, dude, or the daughter's like, dude, now I live in Georgia, 6%, whatever it is, plus 39.6, 37%, whatever it is. Now I'm losing 45 cents on the dollar. Where mom could have given this to me essentially tax-free if she just would have done some basic estate planning. But Josh, there's no inheritance tax. It's income respect to decedent, IRD. Absolutely there is. And even unfortunately, they used to be able to roll that into your inherited IRA and stretch that over your life expectancy, all right? So mom's 80, her life expectancy according to the IRS table is 10 years. We'll just say that, I don't know what it is, 10 years. So she will have an RMD based on living only 10 more years, all right? So eventually, essentially, she's taking 6 to 7% a year out of her IRA to satisfy the required distributions that the IRS establishes. And that increases each and every year, the percentage. All right, so she has to pay more and more tax as she ages. It gets closer and closer to death. I'm 50. I inherit that. My IRA distributions, my RMDs, are significantly lower than hers because the IRS says my life expectancy is 87 years. So I have 37 years for which to draw that money out according to my life expectancy and pay income tax on it. Now, unfortunately, and I haven't gone too deep in this, with the Secure Act, you have to take distributions, exhaust your inherited IRAs within 10 years after a date of death. So mom dies, I inherit it today, I got 10 years for which I have to make those distributions. And I have to pay ordinary income tax on those distributions. So essentially, the IRS is saying, Congress, and rightly so, they're saying, hey, you inherit this IRA, that's great. Go ahead and get that out of there within 10 years or else you can pay stiff penalties. So you have to exhaust that within 10 years. It's no longer based on my full life expectancy where I can stretch out my distributions over the course of my life. Those days are gone. So that is the inheritance that a lot of people are ignorant of, the inheritance tax, that you should not be. I'm just telling you. So if you're a grandma, hey boys, you're sitting there like, oh, I'll just give this to old Johnny. Well, Johnny might be saying, Mom or Grandma, hey, what's up, dogs? Johnny might be saying, Grandma, you could have get it to be tax-free. Now I got to pay tax on this. So just do some planning. Of course, comment if you have questions. Thanks.